Thank you for joining us. We will be discussing the cryptocurrency landscape, and we have David and Andrew from Currency Hub joining us. Thank you for being here.
Thank you, Ash.
Dave, tell us a bit about yourself and how you got into investing.
So I head up operations and trading at Currency Hub. After completing my honours degree in financial analysis and portfolio management at the University of Cape Town in 2010, I moved to London and joined the operations team at a fund of hedge funds before moving to Johannesburg to join a hedge fund as their first analyst with a very operational role that evolved into portfolio management. After nearly 6 years, I decided to take some time off to plan my next career move. So I spent that time backpacking through Southeast Asia and parts of India with a good friend of mine. I returned to Cape Town and joined Iris, a global fintech company, as their financial markets solution specialist, designing, selling and implementing complex software solutions for brokers, asset managers and analysts. During my time at Iris, I followed the crypto space extensively, learning, trading and participating in ICOs, which are initial coin offerings. That's when I saw the opportunity, discovering that Bitcoin trades at a premium. After trading the Bitcoin premium in South Africa for 2 years, I left Iris to launch Currency Hub.
And Andrew, how about you?
I head up marketing and distribution for Currency Hub. I have a social science degree from UCT and a postgraduate diploma in business from Wits Business School. Since 2002, I've worked for myself, having built and sold and lost companies in various fields, which include media, communications, training, recruitment, travel events, just to name a few. I also play an active role in advising several multifamily offices to support their investment objectives. And over the last 10 years or so, I've supported around 50 asset managers with their marketing and distribution, predominantly through my firm Black Onyx, which is a registered financial services provider. Our purpose is to ensure that everyone is better informed about the traditional and alternative investment landscape to ultimately become more sophisticated investors. Dave and I have worked together since 2011 and have become close friends, and he got me into crypto in 2017. We formalized our new structure and his existing crypto-arbitrage strategy in 2019 in order to provide a legitimate crypto service and a consultancy for qualified investors.
Dave, discuss the pressure traditional finance is under with regards fiat, inflation, central banks, sovereign risk, the unbanked, and ultimately why the younger generation is fed up with the old regimes.
Sure thing, Ash. So in 2020, central banks around the world began printing more fiat. Fiat money is a government-issued currency that is not backed by commodities such as gold. The Fed alone printed and pumped $3 trillion into the economy in a 3.5-month period to June 2020. This money was pumped into the economy by buying bonds and financial institutions. The idea behind putting money into the economy was to drive down interest rates and hope that people and businesses borrow and spend more, and in the process revive the American economy. While this increase in fiat might have short-term benefits, it is also eroding the purchasing power of the US dollar and other fiat currencies over a longer-term period. So basic economics clearly shows that the increase in any money supply causes inflation and reduces purchasing power. The reason for this is because the spike in demand exceeds the supply, causing prices for everything to jump higher. The global increase in money supply, in my view, has been one of the biggest catalysts in 2020 for mainstream institutional investors becoming interested in Bitcoin as a hedge against inflation and a depreciating dollar. There will only ever be 21 million Bitcoin in existence and is thus deflationary in principle, meaning the purchasing power increases over time.
David, how does the expected great wealth transfer relate to cryptocurrencies?
So when looking at the current global system or regimes, it is currently in the hands of baby boomers and members of Generation X. While the majority of these people are hostile to Bitcoin, they will not stay at the head of the current system forever. In the years to come, they'll gradually leave their positions to members of Generation Y, noting there are more millennials than baby boomers who, with the younger generations, are already influencing the rise of Bitcoin. So slowly but surely, in the years to come, we will see the biggest transfer of wealth in history to millennials and Gen Z, thanks to technology and cryptocurrencies, to a large extent. The new generations understand that the current system is unfair. They don't want to have to endure such a disadvantageous system throughout their lives. It is even more infuriating when these all-powerful people at the head of central banks are baby boomers and members of Generation X. A new system must emerge as the current system is broken. The Bitcoin system is therefore the millennials and Gen Z's way out to leave the vicious circle in which the current system wants to lock them in. Since 1971, a purchasing power of $1,000 has lost 85% of its value with the economic crisis that we are currently living in, and the great monetary inflation in which central banks around the world have engaged. The situation will worsen even more, notwithstanding the internet has evolved into demand a more efficient digital currency, and the younger generations, most notably the gamers, are well acquainted with the usage of crypto tokens to improve their overall gaming experience.
David, what exactly are cryptocurrencies and digital assets?
So cryptocurrencies are a digital or virtual currency that is secured by cryptography, which makes it nearly impossible to counterfeit or double spend. Many cryptocurrencies are decentralized networks based on blockchain technology, a distributed ledger enforced by a disparate network of computers. I will explain this a bit more on blockchain in a bit later. A defining feature of cryptocurrencies is that they are not generally issued by any central authority, rendering them theoretically immune to government intervention or manipulation. The first blockchain technology created was Bitcoin. Today, there are thousands of alternate cryptocurrencies known as altcoins with various functions and specifications. Bitcoin was launched in January 2009 by an individual or group known by the pseudonym Satoshi Nakamoto. Bitcoin offers the promise of an online currency that is secured without central authority, unlike government-issued currencies. There is no physical Bitcoins, only balances associated with a cryptographically secured public ledger. So some of the alternative cryptocurrencies, altcoins, spawned by Bitcoin's success include ETHEREUM, Litecoin, and Ripple. ETHEREUM is currently the second largest cryptocurrency in terms of market value, which enables the deployment of smart contracts and decentralized applications known as dApps to be built on and run without downtime, fraud, control, or interference from a third party. ETHEREUM comes complete with its own programming language, which runs on a blockchain, enabling developers to build and run distributed applications on the ETHEREUM blockchain. The potential applications of ETHEREUM are wide-ranging and are powered by its native cryptographic token, Ether, which is commonly abbreviated as ETH. Ether is like the fuel for running commands on the ETHEREUM platform and is used by developers to build and run applications on the platform. Ether is mainly used for two purposes. It is traded as a digital currency on exchanges in the same fashion as other cryptocurrencies, and it is used on the ETHEREUM network to run applications. There are thousands of altcoins that have been built upon the basic framework provided by Bitcoin. Thus, most altcoins are peer-to-peer. They try to offer efficient and inexpensive ways to carry out transactions on the internet. Even with many overlapping features, altcoins vary widely from each other. As altcoins evolved, distinct categories emerged. Some of the main types of altcoins include mining-based cryptocurrencies, stablecoins, security tokens, and utility tokens. Mining-based altcoins have a mining process by which new coins are generated by solving challenging problems to unlock blocks. They are more similar to Bitcoin than other altcoins. Most of the top altcoins in 2020 fell into this category, ETHEREUM being one of them. Stablecoins are altcoins which peg the value of that stablecoin to existing fiat currencies or commodities. So an example of stablecoins are US dollar Tether, True US Dollar, True GBP. Facebook is actually planning to launch a stablecoin called Libra early this year. Security tokens are linked to businesses and they often launch in an initial coin offering, better known as ICO. Security tokens resemble traditional stocks and they often promise some type of dividend-like payout or ownership in a business. Utility tokens provide a claim on services, and they are sometimes sold as part of an ICO. So Filecoin is an excellent example of a utility token offered in an ICO. Filecoins are designed to be exchangeable for decentralized file storage space.
David, what exactly is the blockchain and how does it relate to cryptocurrencies?
Blockchain is essentially a digital ledger of transactions that is duplicated and distributed across the entire network of computer systems on the blockchain. Each block in the chain contains a number of transactions, and every time a new transaction occurs on the blockchain, a record of that transaction is added to every participant's ledger. The decentralized database managed by multiple participants is known as distributed ledger technology, DLT. Blockchains is a type of DLT in which transactions are recorded with an immutable cryptographic signature called a hash. In simple terms, blockchain can be described as a data structure that holds transactional records and while ensuring security, transparency, and decentralization. You can also think of it as a chain or record stored in the forms of blocks, which are controlled by no single authority. Blockchains such as Bitcoin and Ethereum are constantly and continually growing as blocks are being added to the chain, which significantly adds to the security of the ledger. Blockchain is the technology that enables the existence of cryptocurrency. So Bitcoin and all other cryptocurrencies is powered by blockchain technology.
Dave, give me a quick intro to Bitcoin.
Okay, so Bitcoin was created in 2009 by a person or group using an alias Satoshi Nakamoto. Satoshi Nakamoto released the Bitcoin white paper, which is a document to outline the principles of a cryptographically secured, trustless peer-to-peer electronic payment system that was fundamentally designed to be transparent and censorship resistant, as well as put financial control back into the hands of the individual. At that time, the world was gripped by a financial crisis catalyzed by extensive speculation in the financial markets and banks risking millions of dollars worth of depositors' money. So this document laid the foundation for what is generally considered the first functional digital currency powered by a distributed ledger technology called blockchain. One of the many groundbreaking elements of Satoshi's electronic payment system was that it solved the long-standing double spend problem that plagued cashless spending. It was no longer possible for a person to spend the same funds twice.
Okay, so let's unpack that a bit more. Dave, what exactly is Bitcoin mining?
So Bitcoin mining is performed by high-powered computers that solve complex computational math problems. These problems are so complex that they cannot be solved by a hand and are complicated enough to tax even incredibly powerful computers. The result of Bitcoin mining is twofold. Okay, first, when computers solve these complex math problems on the Bitcoin network, they produce new Bitcoin, not unlike when a mining operation extracts gold from the ground. And second, by solving computational math problems, Bitcoin miners earn Bitcoin while also ensuring the Bitcoin payment network is trustworthy and secure by verifying its transaction information. When someone sends Bitcoin anywhere, it's called a transaction. Transactions made in-store or online are documented by banks, point-of-sale systems, and physical receipts. Now, Bitcoin miners achieve the same thing by clumping transactions together in blocks and adding them to a public record called the blockchain. There are now an estimated 100,000 nodes actively maintaining records of those blocks so that they can be verified into the future. So when Bitcoin miners add a new block of transactions to the blockchain, part of their job is to make sure that those transactions are accurate. In particular, Bitcoin miners make sure that Bitcoin is not being duplicated, a unique quirk of digital currencies called double spending. There are now millions of Bitcoin purchases and sales occurring in a single day. Verifying each of those transactions can be a lot of work for miners. As compensation for their efforts, miners are awarded Bitcoin whenever they add a new block of transactions into the blockchain. The amount of new Bitcoin released with each mined block is called the block reward. The block reward is halved every 210,000 blocks, or roughly every 4 years. This event is known as the halving. The last halving was in May 2020. This system will continue until around the year 2140. At that point, the miners will be rewarded with fees for processing transactions that network users will pay. These fees ensure that miners still have the incentive to mine and keep the network going. The idea is that the competition for these fees will cause them to remain low after the halvings are finished.
Dave, describe the halving and the positive impact that makes for investors.
So halvings reduce the rate at which new bitcoins are created and thus lower the available supply. This can cause some implications for investors as other assets with low supply, like gold, can have high demand and push prices higher. At this rate of halving, the total number of bitcoin in circulation will reach a limit of 21 million in the year 2140, making the current currency entirely finite and potentially more valuable over time. In order for Bitcoin miners to actually earn Bitcoin from verifying transactions, two things have to occur. First, they must verify 1 megabyte worth of transactions, which can theoretically be as small as one transaction, but are more often several thousand, depending on how much data each transaction stores. Second, in order to add a block of transactions to the blockchain, miners must solve a complex computational math problem, also called a proof of work. What they're actually doing is trying to come up with a 64-digit hexadecimal number called a hash. That is less than or equal to the target hash. Basically, a miner's computer spits out hashes at different rates, mega hashes per second, giga hashes per second, or tera hashes per second, depending on the unit, guessing all possible 64-digit numbers until they arrive at a solution. The difficulty level is a relative measure of the amount of resources required to compete for mining new Bitcoin. It climbs or falls at the end of 2016 block periods, which is roughly 2 weeks, depending on whether the total estimated hash power consumed by the network has also increased or decreased. That is, the more miners there are competing for a solution, the more difficult the problem will become. The opposite is also true. So if computational power is taken off of the network, the difficulty adjusts downward to make mining easier.
David, why is Bitcoin being referred to as digital gold, and is it really a store of value?
So Bitcoin and gold have the following 5 common characteristics. 1, the value from scarcity. There is a finite amount of both gold and Bitcoin. The amount of gold in the earth that has not yet been dug up is estimated to fill another 2 50-meter pools. The total amount of Bitcoin to be issued is locked at 21 million. Number 2, cannot be forged. Gold cannot be created artificially. Similarly, Bitcoin cannot be forged. The blockchain will recognize fake information if someone tried to forge Bitcoin. Number 3, can be divided. Gold retains its value whether it is in large bars or small chunks. Bitcoin can be divided up to 8 decimal places while maintaining value as Bitcoin. They can be split up and used for value exchange. One eighth of a Bitcoin is actually known as a Satoshi. Number 4, the cost of mining. Mining gold incurs some cost. Similarly, mining to obtain newly issued Bitcoin comes with the cost of electricity and capital investment for the hardware required to run the proof of work algorithm. And then lastly, number 5, durability. While prices may fluctuate, they don't decay or deteriorate in storage. In addition to the previously mentioned rarity, there is no risk of deterioration. This makes for both Bitcoin and gold effective for storing value. While Bitcoin is still a relatively young asset, it is still being debated whether it is a store of value, like gold, or a medium of exchange. What was clearly apparent during the pandemic, allied with the pressure on the dollar, was the flow of funds from institutions into Bitcoin, seemingly looking for a safe haven and diversification from equities, bond markets, and pre-existing positions in gold, all of which may have been maxed out. At this point in time, we expect to see traditional financial institutions treated more like gold.
David, how do I purchase and store digital currencies?
There are many marketplaces called Bitcoin exchanges, allowing people to buy or sell Bitcoin using different fiat and cryptocurrencies. So Bitstamp is a leading global exchange, along with Coinbase and Kraken, while Luna and Valor are 2 of South Africa's leading exchanges. Security can be a concern, so when buying and storing digital currencies on exchanges in digital wallets, you need to remember that you're susceptible to security vulnerabilities on that exchange. Storing your Bitcoin off exchange is known as cold storage and can be a lot safer.
What is a Bitcoin wallet?
So Bitcoins are stored in digital wallets, which exist either in the cloud or on a user's computer or on a cold storage device. The wallet is a kind of virtual bank account that allows users to send or receive Bitcoins, pay for goods, or save their money.
And what is cold storage?
So keeping your Bitcoin in cold storage is often seen as even more secure than a traditional wallet kept on exchange. It involves storing Bitcoin offline that is entirely separate from any internet access, and thus substantially reducing the threat of hackers. There are various cold storage methods such as 1. Paper wallets. So a paper wallet is a way to safeguard against hackers or computer malfunctions and involves printing the public and private keys on paper. Since this paper contains all relevant information needed for spending the coins, its safety is crucially important. Number 2 is hardware wallets. Storage devices like a USB-type storage device are also used to keep the secret keys. So such devices can be kept in a storage facility or deposit box to make sure that they don't fall into the wrong hands. Trezor and Ledger are two of the world's leading cold storage USB devices.
Dave, what is DeFi?
DeFi is short for decentralized finance, an umbrella term for a variety of financial applications in cryptocurrency or blockchain, geared towards disrupting financial intermediaries. Most applications that call themselves DeFi are built on top of Ethereum, which sets itself apart from the Bitcoin platform in that it's easier to use to build other types of decentralized applications beyond simple transactions. It's important to note here that cryptocurrencies are not all competing against each other. Although there are some that are, many are completely different. The most popular types of DeFi applications include 1. Decentralized exchanges, DEXs. These are online exchanges helping users exchange currencies for other currencies, whether it's US dollars for Bitcoin or Ether for Litecoin. DEXs are a type of exchange which connects users directly so they can trade cryptocurrencies with one another without trusting an intermediary with their money. 2. Stablecoins. So a stablecoin is a cryptocurrency that's tied to an asset outside of cryptocurrency. Let's call it the dollar or euro, for example, to stabilize the price. Number 3, lending platforms. These platforms use smart contracts to replace intermediaries such as banks that manage lending in the middle. Number 4, prediction markets. Markets for betting on the outcome of future events such as elections. The goal of DeFi versions of prediction markets is to offer the same functionality but without intermediaries. Number 5 is wrapped Bitcoins, a way of sending Bitcoin to the Ethereum network so that Bitcoin can be used directly in Ethereum's DeFi system. This allows users to earn interest on Bitcoin while they lend out on decentralized platforms described above. There are many DeFi concepts that continue to spring up and disrupt traditional financial markets.
David, how does Bitcoin differ from the other digital assets like Ethereum and the hundreds of alternative cryptocurrencies out there?
So Bitcoin is a new currency created to compete against the gold standard and fiat currencies. Ethereum is a token capable of facilitating smart contracts. So what Bitcoin does for money, Ethereum does for contracts. Ethereum's innovation is that it allows you to write smart contracts. So basically, any digital agreement where you can say, if this happens, then something else happens. So let's use an example. If I vote for the president, then my vote is official and no one else can vote as me. Or if I sign my name on this document, then I own the car and you no longer own the car. So up until now, we've carried out these agreements with a signature at the bottom of a paper document. Ethereum dramatically improves this model because it's digital and proof of the transaction can never be deleted. Altcoins use the same decentralized concept as Bitcoin, but take things a bit further with unique features. Let's use altcoins such as Ripple and Dash, for example. Ripple and Dash offer a fresh take on the transactability and speed of payment. Ripple is designed to facilitate cross-border transactions between large corporations and institutions. This would be a replacement of the traditional global SWIFT system. Instead of waiting for days for your cross-border payment to arrive, if you sent Ripple to another user, it would be there within minutes and at a fraction of the cost that you would have paid using SWIFT. Dash claims to have transaction speeds up to 1 second per transaction, so focusing on superior security and an easy ecosystem for individuals to manage their money.
Andrew, who's investing in cryptocurrencies?
Let's go back a step, noting the lack of regulation for cryptocurrencies around the world. and that the investment opportunities have historically been limited to retail investors, i.e. the general public. So, as popularity for the asset class, or TEXOC, which you might prefer, has risen over recent years, so too has the access to trading platforms through easy-to-use mobile apps available to most people around the world. In October 2020, PayPal announced that its customers will be able to buy and sell Bitcoin and other digital currencies using their PayPal accounts. PayPal, having one of the largest merchant networks in the world, is a huge catalyst to the adoption of digital currencies globally. And this is especially good news for the unbanked and countries that are subject to sovereign risk and failed central banks like Zimbabwe and Venezuela, and countries with strict exchange control or limited access to fiat cash. This supports entrepreneurs in far-flung places and megacities, like Lagos, for example. Since its birth, Bitcoin has gone through many different cycles, and we at Currency Hub believe that 2020 marked the beginning of the institutional adoption phase, which saw a number of listed and unlisted global companies purchase Bitcoin with some of their excess cash reserves. Case in point, in mid-2020, during the pandemic, the institutional investors began looking for alternative sources of alpha and means of diversification from the equities and bonds and gold, and this marked the acceptance of Bitcoin. As a result of regulation, large financial institutions cannot own Bitcoin directly, and they are therefore restricted to accessing the crypto theses through the acquisition of publicly listed and privately owned companies who themselves have the ability to invest in Bitcoin. Consider companies like BlackRock, Morgan Stanley, and Vanguard owning shares in the likes of MicroStrategy, Square, and PayPal, who are openly stockpiling huge amounts of Bitcoin, providing an entry point by circumnavigating the regulatory restrictions. But the regulation is opening up. Consider too that Goldman Sachs now includes cryptos on their derivative exchange, and that these are some of the big institutional names and big moves in the right direction for crypto enthusiasts and confidence in this asset class.
Andrew, describe the crypto investment opportunities.
So, the primary investment strategy for the retail investors is in their belief that Bitcoin or Ethereum will go up over time. So, investing in Bitcoin is essentially a strategy to invest in an asset which has characteristics like gold and offers investors a store of value as well as diversification, while investing in Ethereum is more of a play on investing in blockchain technology. Here you simply subscribe to an app, purchase your crypto, and hope it goes in the right direction. If you want to spread your risk, you could invest in a type of ETF fund through an app that bundles the top performing cryptos, and these have become quite commonplace with allocations beyond the ubiquitous Bitcoin and Ethereum into various altcoins and stablecoins. For the more experienced and technically minded, you can perform arbitrage, whereby you look for price inefficiencies between the currencies and the exchanges and trade in and out, trying to make a profit. But this is best left to the experienced investors, many of whom using high-frequency bots, algo trading, which comes into its own risks. Recently, we've begun to see a rise in staking, which is crypto speak for earning interest, on the underlying digital asset. And here investors are essentially lending money to credible exchanges that support crypto traders looking to borrow digital or fiat currency to express their views on the market by taking both long and short leveraged positions. Then there are specific crypto products that invest in DeFi, decentralized finance, which is enabled through blockchain, primarily on Ethereum, opening up all manner of disruptive financial services. This is a particularly interesting space and moving exponentially. And lastly, for the more sophisticated investors, there are around 500 crypto funds, of which there are around 150 long-only type products and 50 crypto hedge fund of funds. And these invest in multiple crypto firms and strategies to reduce their risk by capturing most of the upside and reducing the volatility significantly. At Currency Hub, we've been managing an arbitrage strategy since 2017, which is unique to South Africa and its citizens. Here we exploit the regional price inefficiencies of crypto assets as a result of exchange control limits that exist in South Africa. And through the utilization of our clients' 11 million rand yearly offshore allowance, we trade crypto assets without ever being exposed to Bitcoin.
David, tell us more about the Currency Hub crypto arbitrage strategy.
So South African citizens with an income tax number are able to send 10 million rand offshore for investing each year with a tax clearance certificate. And they are also allowed to spend 1 million rand travel allowance every year. Currency Hub has various institutional relationships with both offshore and onshore cryptocurrency exchanges, forex intermediaries, and over-the-counter desks, enabling low transactional fees, premium 24/7 support, deep cryptocurrency liquidity, and best price execution. This enables Currency Hub to facilitate the crypto arbitrage on behalf of clients, generating an ultra-low risk profit on every trade. It basically works like this. So having completed their FICA proof of source of funds and been issued a tax clearance certificate from SARS, the investor will be able to deposit $250,000 into a foreign exchange bank account opened in the individual's name with one of our authorized dealers. Currency Hub will then trade up to 44 tranches with the 250,000 Rand over 2 months to get to the maximum offshore allowance of 11 million, to deliver a variable return determined by the premium and exchange rate. After each of these 44 trades, the profit is then realized in rands, secured in the investor's foreign exchange bank account, and upon completing the trading cycle, the initial 250,000 is returned immediately. All the while, the investor has access to a live spreadsheet to watch the trade and returns for themselves, with their profits securely stored with the authorized dealer. At the very end of the cycle, our clients are issued a detailed statement clearly showing the premium we achieved on their behalf and foreign exchange rates for all 44 trades and their overall profit. This is then shared with their tax practitioners as a client investment statement. There are certain criteria that a South African citizen would need to fulfill in order to register with Currency Hub to facilitate the cryptocurrency arbitrage on their behalf, noting we treat each client as a qualified investor who would need a minimum of 250,000 capital.
Andrew, can you elaborate on the regulation and legitimacy of the crypto arbitrage investment opportunity?
So as of today, January 2021, the crypto space is largely unregulated, causing all sorts of concern for the likes of the FSCA, the Financial Service Conduct Authority, the South African Reserve Bank. These guys are dealing with Ponzi schemes like Mirror Trading International and hundreds of scams, which are sadly commonplace in the pioneering environment like this. The South African Reserve Bank itself is trying to oversee the flight of cash, both on and off its balance sheet, while SARS, our revenue service, is trying to get all the taxes owed to them. We believe we've addressed these concerns, addressing all 3 state institutions as follows, unlike most of our peers in the crypto space. So, number one, both David and myself have been in the asset management industry for over 10 years, with backgrounds in hedge funds, adhering to very regulated environments and meeting requirements of institutional and high net worth investors. We've built our businesses on those principles, and with that experience of mind, we've established 2 independent FSPs, Cat 1 and Cat 2. And this is monitored by the FSCA and allows us to provide advice and intermediary services and to manage money on a discretionary basis. We couldn't be more regulated from an FSCA standpoint and anticipate the imminent arrival of regulation, which we gladly welcome. Number 2, after establishing Currency Hub and on the back of a fact sheet with over 2 years trading history, we then decided to go retail, but on one condition, that we approached the South African Reserve Bank with our authorized dealer and got legal opinion to legitimize our operations. We went live in mid-2020, comfortable in the fact that our process was understood by the regulator and our authorized dealers, and that they knew who we were, and that we were also supported by top legal minds in the Currency and Exchange Control Act. Number 3, any South African profiting from cryptocurrencies has essentially triggered a tax event, income tax, and is therefore subject to this taxation. This has been a grey area, but the South African Revenue Service has recently expanded on their documentation, and taxpayers now need to declare these profits. We work closely with professional tax consultants and legal counsel to ensure that our clients and our own operations and reporting standards are one step ahead to support the South African receiver and the growth in digital assets. The FSCA is working hard towards regulating this landscape, suggesting all crypto service providers will require financial services licenses to operate legitimately.
Wow, that was so much information. Andrew, Dave, thank you so much for sharing all your insights with us today.
Thank you very much, Ash.
Thanks.